budget at the full 2% drop? Because this is where it gets interesting, right?
Yeah, you got your phone out there?
Yeah. I got my phone right
so
here.
6.3 at $400,000 purchase, or sorry, $500,000 purchase. Okay.
Yep.
32.49.
Yep.
Let's say it goes down by 2%. Okay.
So 32.49.
You're now going to be able to afford. Let's just.
My budget is $500,000 at 6.3 variable rate with a 38.91 debt ratio, 5% down.
30.
Monthly payment is $32.49 a month. If we go and decrease if we follow by the CIBC projections and we go down by a full 2% by the end of 2024 for variable rates, my monthly payments are.
Okay, you ready?
Yep.
Now you can go up to.
Welcome back to the Halifax Real Estate Podcast. I am your host, Jason Paul, licensed realtor, team lead at the Infinity Real Estate Group at eXp Realty in Halifax, Nova Scotia. And I'm here to help you gain a better understanding of real estate in Halifax. Hit that subscribe button, and the Halifax Real Estate Podcast is now on Discord, where I break down our upcoming guests, topics, and hopefully create a little more engagement with you guys so you can have your questions answered as well. Now back to the show. Interest rates are coming down in 2024. That's what Canada's major banks are saying. Andrew Hutchison from Mortgage Architects is back on the podcast to break down CIBC's prediction of interest rate decreases for 2024. And we break down what this means for home buyers, the real estate market in general, and what these decreases could mean for monthly mortgage payments and purchasing power. Enjoy.
Interest rate cuts will be the story of 2024. What that means for mortgages and more. Stay tuned.
That's a great intro. Will they?
There's your hook. There's your hook for the podcast. Yeah, that's going to be the story, man. Interest rate cuts, where they're going to go, how far they're going to drop, what that means for the market, what that means for mortgage payments.
Why are they okay? The reason we're doing this episode is because you called me. So what are they projecting rates to drop by the end of 2024? And who is projecting this?
Yeah, that's a good question. Depends what bank, what economists you look at. And for everyone listening, the biggest thing to remember here is there's no crystal ball. We don't know where rates are actually going to go. It depends on so many factors. But if you're looking at Ben Tall out of CIBC, he is predicting a 2% decrease in the overnight lending rate, so variable side, in 2024, which is aggressive. I think it's a little aggressive. I don't think they'll drop that much, but it is kind of exciting, interesting to see these headlines, to see these predictions, because for obviously the last year and a half, 2 years, it's been the opposite, and everyone has been expecting rate hikes. So I do think it'll go down this year. I'm thinking closer to 0.75, maybe 1%. But there are head economists of the country that are predicting as high as 2.
They're predicting as high as 2.
Yeah,
we're gonna fall at 1, and I think one and a quarter.
Yeah, I think for the, I kind of throw, to simplify things, I like to throw rates into like 3 different categories. Obviously, you have your variable rates, and then on your fixed side, the most popular are your 5 and 3 year. So if you have 3 different categories, those are
5-year and 3-year fixed.
5 year on the fixed side, you have your 5 year and 3 year. Those are going to be like your best price points. 5 year being the lowest, 3 year being a little higher, but 1 year terms, 2 year terms, 4 year terms being higher than the 3 year and 5 year. And what we're talking about here is kind of on the variable side, right? And the variable side is the Bank of Canada's overnight lending rate.
The prime rate.
Prime rate, and then you get a discount off that. So let's say you're prime minus 1%, prime at 7.2 right now. If your mortgage is prime minus 1, you'd be at 6.2, 1% lower than prime rate. And so as these predictions come in and we see, a possible 2% drop, that's pretty significant, right? It's going from 7.2 to 5.2. And if you're prime minus 1, you're now at 4.2. So, it's exciting to see it. And, who knows what's going to happen. I think it's aggressive, as I mentioned, but it is exciting for us in the mortgage and real estate industry to hear. It's headlines.
Wild to hear after the last 2 years of rates. Now, okay, prime minus, if we come down to the prime rate, which affects the variable rate, by the end of the year, CIBC, Ben Toll, I think you said the name.
Ben Toll, yeah.
Ben Toll, projecting 2% to come down.
Mm-hmm.
Now, okay, you said you think 0.75 to full 1. I think I'll be at 1 to 1.25 by the end of the year. Here's a question, right? If let's map this out, because we know when the Bank of Canada meets. Everyone knows when the Bank of Canada meets, thanks to the last 2 years.
I can map it out really easy for you too.
So map it out because here's the idea of like, okay, let's say they actually reach 2%.
Yeah.
Which I don't agree. I don't believe.
Know what that looks like?
What does that look like for the year? When do you think we hit the 2%? You know what I mean?
How about I give you a detailed prediction?
Give me a detailed prediction.
According to Ben Tull. Okay, so no change. January 24th, March 6th.
Okay.
Possible 25 basis point drop April 10th.
Okay.
Possible 50 basis point drop during June 5th and July 24th. So
5 and 5.
0.25.
Yep.
For both equaling 50 or 0.5%, just on one of those dates. And then a 25 possible basis point drop on September 4th, October 23rd, December 11th. If you add all those up, it's like 3%. So they're saying during those times is when we'll start seeing the moves. We're going to see a little bit of move in the early spring. So April, we'll see hopefully a decent size decrease,
lot of movement in the summer.
Yeah, in that June, July. And then through the fall, if those, so long as the economy reacts well to it, we may see a few more quarter point drops in the fall.
Okay.
That is the detailed prediction from these head economists. It'd be nice to own a crystal ball. Let's say that it'd be nice to own a crystal ball and know exactly. But to your point, we won't see that if it does go to a 2% drop this year, it would be like towards the end of the year before you get to that full 2-point drop.
Yeah,
it's going to be
it's going to be the October meeting, the October-November meetings when they actually,
or even December 11th could be the last.
Even December 11th, it's going to be the last quarter Q4 of 2024 when you actually see that 2% if it comes. When it's actually realized, December 2024 is when you're going to finally see that 2% drop.
Yeah,
I disagree with 2%. I think you're going to see only 0.25 basis point drops. And you might see, in my opinion, you're going to see 4 or 5. But once again, no foundation for this opinion. We're purely speculating.
Yeah, and I mean, to that point too, like, yes, I am a mortgage broker and I'm in this world every day, but I'm also not an economist.
Mm-hmm.
I'm not, my day-to-day operations is not observing the economy and predicting where things are going. But I do receive, and I'm privy to a lot of the information of these head economists that provide to us to show us where the direction of the economy is headed. And they give us their predictions. And then based on our experience is really all we have to draw on what we think is going to happen. I think that's heavy too. I think a 2% is
heavy-handed. It's heavy-handed.
It's heavy-handed. I think we'll be, again, closer to 0.75, maybe up to a quarter.
Why now? Why were they looking to change? Because if you talk about the impact of rates and what was 2022, and you and I both worked in that market, we talked about that market a lot on this podcast and the mayhem that was 2022. You and I both bought houses in that mayhem, right? If you look at the impact of rates, you would say rates were successful in doing what the goal was, which was to slow down the real estate market.
Yes.
Right? From the peak of the market to now, we're down $70,000, $80,000. Instead of having multiple offers on every house in excess of 10, 20, sometimes 30, sometimes 40, we're now able to negotiate on some houses and able to get in and buyers can take their time in writing an offer and negotiating on certain things. So in terms of what the purpose of the rate hikes was to slow down the real estate market and other markets and to stop consumer spending. You can say that it's been successful, right? Days on market's up, inventory's up, prices down, impact of rates. So after 2 years of successfully looking at rates and paying them out, inflation's a big part of that. Bank of Canada, Tiff Macklin always want to get us down to 2% inflation after the peak when it hit 10 at one point? Something like that?
Yeah, it went pretty high, yeah.
So if that's successful, why release? Because the concern would be if we start seeing rates come down, the market heats up again. So why now are we taking the foot off the gas on rates?
I think there's an important distinction here especially when we're talking about the prime rate, because the housing explosion, it wasn't the only reason for the Bank of Canada increasing that rate. The inflation was getting to a point where it was approaching double digits. And because these are lag factors, so like when inflation hits, it doesn't actually take effect in the economy till 12 to 24 months later. So, and it's same with the when you raise
interest rates.
Sorry, yes, if I can talk. When you raise interest rates, it's the same thing. It's a lag factor, and so when inflation got to a certain point, it wasn't so much that the housing, although it was most definitely a contributing factor, they needed to increase rates for the economy in general.
Okay.
And now that the rates have gone up, they wanted to stop consumer spending, and that is across the board, right? So things like consumer debt, shopping,
car
loans, everything. They needed to slow down the economy because it was accelerating too fast. Now that inflation has come down, and we're approaching that 2% inflation, which is where the Bank of Canada wants it, they can now ease up on those interest rates, because now they can allow people to start spending a bit more because they're bringing that down. And this is always going to be on a spectrum. It's never going to sit in one place. Inflation is going to go up and it's going to go down based on the economy, what's happening in the world, so many different factors. And so as that inflation comes down, then they can also bring down those rates as well. And so will that have an effect, to your point, of where before there was a lot of competition in the market because the rates were low? It brings in more buyers. You can afford more, so people are putting higher bids in homes. Yes, that will come with it, and that was how it was. That's exactly how the market was 2 years ago. But they're also not going to go down to those super low interest rates that we had post-COVID.
Back then,
it won't go that low again. But it will. For sure, lower interest rates means lower mortgage payments, means you can afford more. It means there's less, as a first-time home buyer, or even a buyer in general, I'm less nervous knowing that rates are lower. So maybe I'm entertaining the idea of buying a new house, upgrading my house to a new house, a lot more now that I know that rates are lower. So it will bring more.
Well, it brings consumer confidence back.
It'll bring more people to the pool party.
Right? Because as soon as because the messaging for the last years has been real estate's a bad time. It's a bad time to get in the market. No one knows what rates are doing. No one knows where they're going to settle. You saw predictors predicting rates increasing to double digits. They you heard that in late 2022, early 2023. You would hear, it's probably going to get up to 10%, 11%, 12% before they start seeing a decrease because of inflation and home prices and yada, yada, yada. So to see it now, the rest at 6.3 or 6.2, which is what variable is right now, I believe.
Yeah, 7.2 is where
prime is.
Prime is, yeah.
Yeah, so let's even get a little deeper into this. Prime's at 7.2, so minus 1%. 6.2 is what you're giving out right now with banks.
Yeah, 0.9 would be your standard one.
Okay.
Some banks are offering minus 1%, but yeah.
So let's say 6.2, 6.3.
For easy math, minus 1%. Yeah.
Exactly. So you're at 6.2, right? Now we have the stress test. So if I'm buying a house here, if you're buying a house or someone's buying a house, we want variable because we know variable is coming down. So therefore, it's a good time to get to variable, right?
Yeah, sorry, you're talking about two different things. Stress test.
I'm getting there.
Okay.
I'm getting there. You want to go variable.
So variables, yeah. And so, and I guess very depend on the person, but a strategy right now is you could go variable as rates come down, because fixed rates are coming down as well. Once they come down in 12, 24 months, you can lock in. You can always switch from a variable to a fixed. No fee.
Exactly.
And lock in.
Yeah, so you can ride. So if you're buying a house today, you can go variable at 6.2, right? And then you can ride the prediction from CIBC that they're going to come down a full 2%. We'll see.
Yeah.
Okay, but if you go 6.2, the stress test kicks in, right? Because then you're being stressed at 8.2.
You got it. Yeah.
Okay. So if I'm buying, I have to be given a rate. I have to be qualified a rate of 8.2, which is bringing down prices in the market, especially the higher price points, because being qualified an extra 2% on the interest rate means you're approved at a much less spending power on purchases, which is why the 6, 7s, 8, 9s, $1 million property priced homes have been slower, because the stress test, and the high interest rate is killing those markets.
Yeah, it's an expensive mortgage at 6.2%.
Yeah. So with that regard, if we come down a full 2%, 4.2. You're still being stressed at a 6.2.
If you buy at that point.
Yeah. If you buy at that point. If you buy at that point. So when you're talking about the overall picture of the market, right, and what we're going to land at, there's a lot more things that come into play than just rates come down, because you're still being stress test. The market will be the market when it's time to get in. And if rates come down, buyers coming back. So it's a healthier time in the market. Now, you mentioned something that I want to pick up on, fixed. Fixed is coming down right now, is it not?
Yes.
And it has been coming down.
Yes.
So where was fixed and where was fixed at its peak and where is it now?
Fixed at its peak was for a 5-year fixed back in the fall was in the high fives.
Okay, so 5.75.
Mid to high five. Yep, mid to high fives. And it's come down substantially since then. Right now you can get a 5-year fixed for 1 second, my thing.
He's pulling up the information on his computer, guys. We want to get accurate data.
Yeah, I want to see. So the 5-year fix it follows our 5-year government bond yield.
Okay.
And so on, let's say October 23rd, the price on that was 4.3. I might even go a little bit further back here. Let me see. Yeah, October. What's the date here? It's in the thing. October 6th, 4.293% was where the bond yield was, and now it's at 3.4.
That's a huge swing.
So it's a full point lower within the last 4 months.
Yeah.
And so that has a direct correlation with our fixed rates.
Yeah.
Our fixed rates have not quite come down to the sub fives yet. So caveat there are some products that have, but for the most part, you're right on the low fives, anywhere from
5.1, 5.2, somewhere in there.
Yeah, 5.25, 5.25 would be pretty standard right now. There's some products out there you can get a little bit lower than that.
Okay.
And we should continue to see that trend downward if the bond yields keep going.
Okay. So market rates coming down essentially. Bonds and fixes are on its way down. They're predicting 2%. I'm going to bring that up this entire podcast. They're projecting a 2% drop by the end of 2024. Is this a good time to buy a house, in your opinion, based on where rates are going?
There is not a better time to buy a house than literally today.
Why today?
Because every day you wait, rates are going to go down.
Okay.
And every day that rates go down, more buyers are going to walk through the door. Those buyers are going to be able to afford more than they were, and you're going to see prices reflect that. There's going to be more competition, which drives prices up. There's going to be lower costs to get in the home, which is going to drive prices up. So if I have a mortgage at 6.2% versus 4.2%, your mortgage payment is going to be, pretty different.
Yeah.
But if I can afford $3,000 a month, then what we see from buyers is they say, I can afford $3,000 a month. Okay.
Yep.
Whether that buys me a $400,000 home or whether it buys me a $600,000 home.
Depends on the rate.
It depends on the rate, but it's also, we see buyers only care about their monthly cash flow. So if they can afford the home, whether it's $400 or $600, they will continue to buy at that because people look at their monthly cost
and what they can afford. Yep.
Now, a really good, quote or something that I live by is date the rate and marry the house.
Yeah.
The rate's going to change. The house is not. The house is going to appreciate in value. So if you buy right now, rates are high, but it's also going to be the cheapest you're going to find a house for the next couple of years. Because if rates keep going down, it's going to drive those prices up because that $3,000 a month gets you a lot more in 12 months than it does right now.
Okay, well, let's talk about this because we have the map. We have the Bill Torr map, or Bill Turr. I'm never going to get that name, from CIBC, who maps out rate decreases. Bentall. I got that so bad. So Bentall's map from CIBC where he maps out the year in percentage points and what they're going to decrease by. So Halifax goes by traditionally 4 markets: spring, summer, fall, winter, right? Spring and fall are our two primary busy markets. We didn't have a fall market last year. It died a very slow and painful death. There was very little activity. Spring market's a busy market of the year, which is usually April to end of June. Summer market, July, August is really slow. September, October, November tends to be your fall market. Winter market, December, January, February, March, into the spring market again. With the first rate decrease, this guy mapped out April 6th as the first rate decrease of 0.25. Right at the beginning of the spring market.
The March 6th is April 10th.
April 10th.
Might be the possible. His prediction.
His prediction is the first rate decrease right in the beginning of the spring market, which is the busiest market of the year.
Yes.
If we get that, what happens in the spring market with buyers, in your opinion? Because you work with them just like I do. So what do you think happens? And when that rate goes down, we all hear that because you're going to see a bunch of content on it on social media. People are going to be talking about it. The media's going to be talking about it. So buyers see this messaging April 10th.
Okay.
What happens?
And I'm just as you were talking, I was going through my emails. 6%, like 5.94 was back in October was the average fixed.
Okay.
And right now it's you can get them on the low fives, but 5.25 I'd say would be the average. What's that going to do? The April 10th, if they lower it by a quarter point, it's going to not do much in your affordability, but what it does do is add momentum. It's motivation. It's positive. It's a positive. It's positive news and energy, which creates momentum and
speculation, because then you get into speculating. Well, what's the next one going to do?
Yeah, and so and I guess when I say buy today, I am, of course, just trying to be, I guess, a little polarizing in my message, and that is that you have some time, but if you wait 12 months, it's going to be a completely different market than it is now. And if that house that you're looking at buying, although you have a high interest rate right now, you can buy for $50,000, $75,000, $100,000 less than you could in 12 months just because you're waiting for a low interest rate to come by. You're going to save a lot more money by buying it at a cheaper price with a high interest rate than a higher price with a low interest rate.
Yeah, 100%. We talked about this. We talked about this on the podcast recently with Richard Payne about the market. Yeah. And we had found out through the numbers that the market crashed, because everyone predicted the market crash thanks to raising interest rates. Mm-hmm. The market crashed. The lowest price point since the raise of markets was August 2022. That was the lowest price point in Atrium.
Interesting.
If you closed on your house in August 2022, that was the lowest price point in Atrium. Right. It got closer to it. I think December 2022 and another month into 2023's got down to the 480s, because that was the lowest point, was 480. I think it was 482.
Right.
That was 5 months after the first rate hike. Right. The rates weren't even done being raised. People just got acclimated to the market and got acclimated to raising rates, so there was less fear mongering in the market.
Yeah.
So if you're going by that standard and watching market trends, well, if we lower the rate in April, you're going to get a lot of speculation. You're going to get a lot of people coming back to the market because consumer confidence is back. And a lot of people saying, okay, well, maybe I'll go variable on this now because it looks like it's coming down again. And we'll see where they get down to, especially if they're projecting 2%. Because if right now people seem to think, we talk about the Halifax market is cooled. We understand that days on market's up, prices are down. We know that. The only reason that's down is because of rates. It's the only reason. Everyone seems to think that, it's slowing down. It's going to come back to what it was. The problem with the market and the rates is the only thing rates did was remove buyers for a temporary period. That's all it did. Mm-hmm. There's a bunch of buyers right now sitting on the sidelines, and when rates start swinging and the message swings, they're going to come back into the market. And we see it this year. I've talked to a few agents that since the start of 2024. I've been in 3 multiple offers. Been almost in a fourth on land in rural Nova Scotia. That's been on the market for 100 days.
Interesting.
You're starting to see it.
Yeah.
Viewings are up. I have, on this night alone, I've got a client, new buyer. I've got him scheduled for 5 viewings tonight. We're going through Bedford, Hammonds Plains, Middle Sackville. 3 of them have just been canceled because accepted offers.
Oh, wow.
3.
Wow.
So in terms of watching the market heat up, it's already seems to be.
Yeah.
We're recording on
16th,
January 16th, Tuesday, January 16th. I got back to work Monday the 8th.
Yeah. Yeah.
It's been 8 days.
It's been busy. And
it's been busy.
As a mortgage broker, I've had one. I've had it's almost a daily new client come through the door right now.
You're a daily new client.
Yeah.
New catch.
It's
someone that needs to do something with a mortgage.
Yeah.
So if you're getting one a day, and I'm getting in multiples in random parts of Nova Scotia. Now one of them was Halifax Peninsula, but that probably was over $1 million.
Yeah.
Talking about $1 million house, multiple bids. And they already had an accepted offer on SOBP. So there was actually 3 people that wanted to buy it.
Yes.
Right? So when you're talking about this stuff, in terms of market getting hotter, well, that's what it's like now, just because the messaging has changed.
Mm-hmm.
The only thing that's changed from the dead fall, and it was slow for fall, is we didn't know what rates were going to do. And then we get into December, roll into January, and speculation begins. They're coming down. That's the only thing that's changed in the market.
And the fixed rates have come down 1% on the bond. Sorry.
Yeah.
Fixed rates are almost down 1%, but bond yields are down 1% from October. So
yeah. So you have that impact as well.
So that ball's already started rolling, and now the information about where the variable rates may go is helpful too. Because the other thing you have to realize here too is when that prime rate comes down. Okay, a lot of debt starts getting cheaper, not just your mortgage. So the cost of living in general right now is high. And as these rates come down, it's going to affect other things. You're going to start seeing car loans be a little cheaper. Instead of being at 7.99 or whatever they have been, you're going to see them start to be at 5, 3. And just your general cost of living is going to be lower. And when that's the case, and you're saving $100 here, $100 there, and it allows for you to spend more on other areas, and that's
your housing's usually one of them.
Be one of them,
right?
So that, back to your point, if August was the cheapest point to buy real estate,
2022.
2022.
Yeah.
Okay. Sorry, I thought you meant last August. I was like,
oh, it was still cheap.
Yeah,
that was the second cheapest month of the year.
What's Korea saying that they think prices are going to go up?
Canadian Real Estate Association's Korea. I haven't actually read the Korea report. I probably should have.
Yeah,
but
because if it's let's say it goes up 5%, I think
it'd be higher than that.
I think so too.
I think it'd be higher. I think you're looking at 10, 12, 15, probably.
Let's say 8%. Let's say it goes up 8%.
Yeah.
If you're looking at buying a home that's $400,000, it's now next year worth $432,000.
That's 8%.
8%.
Okay.
So when I go back to my point of saying date the rate, marry the house, your rate you can change. The price of your house, you can't.
Yeah.
So if you can buy in a higher interest time, although you're paying more to buy the house or you're maybe spending more on a monthly basis, there are strategies like you mentioned, going in variable as it comes down. You can flip into a fix, so wait 12, 24 months, flip into a fix, or get a shorter term fixed rate and ride that out at a higher payment. But then once that's up, all the houses that are around you are now worth 32, or if 2 years in a row, another 70,000 more than you bought it for. But you're still, instead of waiting a year or two, you got in when it was interest rates are higher, and then you renew at the lower rates.
You've done well.
You've done
really well. You've gotten a good deal. But you can't really talk about that way anymore, because that way, if we're right, and if CIBC is right, and Korea is right in terms of raising prices, then that window of buying when the rate's the highest, the market's the slowest, getting a good deal on the buy, and then riding the rate down, that strategy's gone.
We're still in it. We're still in the low. There will never, I shouldn't say never, for the next few years, there's not going to be a cheaper point to buy real estate than right now.
Right now, today.
Yeah. The past, yesterday's gone.
Absolutely. You can't.
So if you're listening to this and you're wondering if I should get into the market, the answer is yes.
You should get pre-approved right now.
Get pre-approved, get in the market. If you're waiting for rates to come down, you'll pay more for your house.
100%. Yeah, as soon as you wait for rates to come down, everyone's waiting for that. You get more buyers to the table who can afford more. Then there's competition on your house. Yeah. And there's already competition, and there's been competition. It's not been... The competition for the last 6 months has been on well-priced, renovated homes. Nothing wrong with them.
Right.
The homes that need work, new kitchen, new bathroom, new flooring, new paint, all that, even just isolating one of those things alone, those have been taking a little longer to sell, but they've still been selling. So we're still in competition on newly renovated homes that are well priced. If you go into this spring market and that 0.25 drops, it's April, May, June is when we get the highest inventory of the year. Inventory being new homes listed to the market for sale. People wanting to trade up and trade down. That 0.25 is going to be ready, and they're going to release that for that market. And what that means is, if you and I have someone willing to shop spring market right now, what are they doing right now today? They're being pre-approved. They know they're already talking to us. If they want to buy in March, April, May, June, they are talking to us right now.
Oh yeah. They're getting ready. Is what you're saying.
They're talking to us there, and if they're not talking to us today, it's by the end of February. Anyone that wants to make a move in March, April, May, June, their docs are being put in a row right now of pre-approvals. They're being told what they can afford. Then they're trying to figure out if they want to go variable, because everyone's projecting rates to come down. So it's time to go variable because you can ride the rate down, or they're going to lock into a good fix at 5.25. One of the two. They may not have bought yet, right? But if that 0.25 comes down, that's only going to benefit the people that are ready to work to use that rate.
Yeah, you ready? While you were talking, I did a quick calculation for you. So if you bought today at that example we just talked about, $400,000.
Well, here, you know what? Instead of doing that, how about we use the actual pricing? Because I've got the stats. I've got Halifax's stats.
Sure.
Right? We can use the average price point for December, and we can give them an actual.
No, here. Let's, because I got this. It's easy math.
Okay.
So $400,000. Okay, if you bought, say you found a house today that's $400,000.
Yep.
5.25% is your 5-year fixed.
Okay.
Let's say we're not talking about one of these strategies of renewing in a couple of years, whatever. Let's just take where those are at. You could do the same thing with the 3-year fix, but I've already done the calculations here. So 5.25%, your mortgage with the minimum down payment, $2,355.
Yeah. Okay.
Let's say you wait 1 year until rates are at 4.25, 1% lower.
Yeah.
But in real estate's increased 8%, so now it's $432,000.
Yep.
Your mortgage for that property, also you need a little bit more down payment, is now going to be $2,315, a difference
of $40
of $43 a month. But in scenario one, if you bought today, you have $32,000 more equity in your house.
Yeah. But that's been the give and take of rates, right? Because as soon as...
But that's my point, is buy right now. You think that you're going to save money by waiting till rates go down.
No.
It's going to be, your mortgage payment's going to be similar,
yeah,
but you're also going to lose all that equity, that room.
Yeah, because the houses haven't changed, right? Like, you can talk about new houses.
This is the exact same it was 1 year ago.
Yeah, exactly. So you can talk about the housing market in a sense of like the houses inventory we currently have for sale. That is in the state that's going to be it. Because when you go to sell your house, people do the things to make the house better, which is standard paint, maybe some trim, maybe a new door or two. Maybe they update the kitchen countertop or backsplash, or they do little cosmetic things to help them sell their house better for a better dollar. Fundamentally speaking, though, that house and location won't change. They're not going to do a major gut renovation to sell a house. No one's doing a full gut to sell a house. No one's going to go in there and rip out the kitchens and bathrooms and backsplash and countertops and change everything to sell a house. So realistically, that $400,000 house, to your credit, is going to be the same house. It just happens to be 1 year later. You're paying the same price, but you're out $32K on a loan.
Yeah, I'm saying if, like, for example, you helped me purchase a property.
Yep.
If I came to you today and said, I want to sell this house, and you tell me it's worth $400,000.
Wait a year.
And I said, wait a year. And then in 1 year you come to me, I'm not going to touch the property, but
yeah.
And then you come to me 1 year later and say, okay, now because it's gone up 8%, now it's worth
$432. You could even argue that in a sense of like, for someone that's waiting, and maybe you're waiting for the right number to sell your house because it makes the most sense. Well, that 8% increase is across the board. So whatever money you would make on the $432, right? Because you had another year of paying down your debt, you're clearing out more at $432. You're still going to spend the same profit on the buy.
Yeah. So I was only bringing. So it brings up a really good point. But backtrack 1 sec before we go there. My only point being, if you are if I were to put my property up, the one that I'm talking about, today it's worth 400. But if I do nothing, next year I'll sell it to you, but I'm going to charge you 432 now because real estate's gone up 8%.
Yeah.
If you buy it right now, then you as the buyer is going to make that $32,000.
Yes.
I'm not selling my house. Someone else will buy it right now if I want to sell it. I'm just saying, if you are someone out there who's thinking of buying, the sooner you get in the market, the more equity you're going to have in your home. The payment, although rates will come down, won't be as drastic as you think it is because the price is going to go up.
Yes. Okay.
That's my point. But to your point, on the flip side here, if you own a home and you are thinking of selling it, then you may want to hold on if you're looking to get more money. Now, if you are looking to buy and get into a new property,
I would do it now.
Then
you should sell now.
Then you're getting a bit more complicated situation. But if you just have a property you're trying to unload,
wait a year.
Then wait a bit of time.
Yeah, wait for that full 2%.
Yeah. And that's saying 8%. So like if it goes up more than that, like if real estate goes up 10% or more than that, then this difference is even then right now with the higher interest rate may end up being cheaper. So let's say it goes up
10%, that 400 turns into 440.
440. Now your payment is $2 more. It's $2,357 at a 4.25 at 1% lower.
So you're doing you're only taking off 1%. From the fixed.
Yeah,
you're taking off 1% from the fixed. It's crazy that 1% adds a $40K and your payment's the same.
Yeah, it's actually $2 more than if you bought at
$400,000.
$5.25 is $2,355, and for $440,000 purchase at 4.25.
Okay, so bring up that map again for the year because this is I'm fascinated by this because.
Now again, fixed rates could drop more than that. We don't know, but
this is speculation.
It's speculation.
We're going by the.
It's good to know the numbers.
It's good to know the numbers, and we're going by the forecast from head economists at our biggest banks. So we're looking at CIBC's right now, and we'll post a link in the show notes so you can look at it yourself.
Yep.
But here's what we're looking at. So April 10th, 0.25. When's the next rate decrease? That's piece that they're projecting.
June 5th to July 24th.
Okay, June 5th or July 24th. How much?
Either a quarter point each or maybe a 50 basis drop on one of them or maybe 50 on both.
Okay. 50 basis on both would be aggressive. So let's just go by quarter point.
Well, if you're doing 2% for a year, then
you have to get there.
1% is 250 point drops.
I still think it's aggressive. Let's go.
So do I. I'm just reading you the detailed predictions for 2024 rate changes.
Okay, fine. We'll go 0.5, 0.5 for.
No. Okay.
We'll go 0.5 decrease. We're gonna follow their prediction or projection. If we do 0.5 in June, 0.5 in July, what does that do to the fall market? Because summer's always dead. The summer is always dead. Every year it's the lowest average price point in HRM because in the summertime, most people go on vacation, most people travel, most people do not want to buy and sell a house with their kids home from school. The summer is dead. It's always the best time of year to get a good deal in real estate no matter the rate. Now, that being said, if you look at the summer months, June and July and August as dead, meaning not much inventory, not much action, you're going to ramp up towards your fall market, spring, October, November. If we have 0.5 decrease and 0.5 decrease, so we've dropped a full 1.25% going into the fall market. What does the fall market look like?
Yeah, you tell me.
Yeah,
man. That's that would be a lot of momentum. I honestly think if that happens, and if there's 50 basis point drops, then
pandemonium.
Then I think the summer would actually be probably more active than usual.
The summer would be active. You'd get more people in the market in the summer, but you would tee off.
Especially if September comes around, they do another rate drop in September 4th. Then
what's that say for September?
September 4th, October 23rd, and December 11th. So
for what?
A quarter point.
Quarter point each.
Yeah.
Okay, so September's a quarter point, October's a quarter point, November's a quarter point.
Mm-hmm.
Okay. If we get into September, right, and we've dropped 1.25, and they drop another quarter. Because once again, if you're planning on buying in the fall, you're doing your pre-approvals in July and August. You're getting your ducks in a row for those during those 2 months. So that way you are ready to transact in September, October, November, December, the fall market into the winter market. If your ducks are in a row, you got your down payment, you got your closing costs, you've done your pre-approval, you know how much you can afford. And then you get another bonus 0.25 off the top come September. That fall market will be the busiest market of the year because it will be competition.
Yeah, that'd be a busy market.
It will be competition. It will be multiple offers. Prices will go up because by yours, right? Take your math that you got on your computer in front of you. Take off, we're at 1.5 off come the September market. So take your $400,000 purchase price and
I was doing that on fixed rates.
Apply to the variable. Let's just see how much the payment is.
What the difference is?
Yeah, because if you're buying a $400,000 house at today's variable rate, so what's today?
Let's say 6.3. I'll use 6.3.
Do 6.3. So you're buying $400,000 house, 5% down payment at today's 6.3 interest rate, and we're on January 16th.
You are at $2,859.
$2,859. You fast forward by their projections, September 4th, 1.5% off the top. So you're at math 4.7.
Oh, what did I do there?
5% down payment at 4.7 interest rate. Where you at?
4.8.
4.8. Where you at?
4.8. There we go.
Because this is the key. This is going to impact the market. If you're at $2,800 on one purchase,
you are about almost $400 less a month.
$2,400.
So $2,479. So just below that. So $2,479. So let's just subtract that by that. So you are $380 lower.
$380 lower. Just same house, $380 cheaper.
Yes.
That's a big difference.
Big difference, yeah.
For a lot of people.
That's I did that at $440, by the way.
Yeah, $440.
Yeah.
So
either way.
So $440,000 purchase price. Mm-hmm. You're at $2,800 a day.
$2,859.
$2,859.
If the price doesn't go up by next fall, say it's still $440, $2,479. Obviously, if the market gets hot, then that's going to go up.
Of course, we can speculate on price, but we can't guarantee what price will be.
There you go.
Right? But if you're looking at this example, you can say, okay, well, it's $300 cheaper, $370 cheaper, $380 cheaper.
Alone for $440,000 purchase is $380 cheaper.
See, that's a big
a month.
That's a big difference.
Yeah, it's almost car payment.
It's 1.5 car payment.
Used car payment. but yeah. I mean, I don't know. That's your utility bills, right?
Right.
So like it's
that's taxes.
It's significant.
That's taxes, utilities. That's gas. Right. That money goes somewhere else.
Yeah.
If that comes into play, we're going into the fall market, and then you get a number 0.25. So let's finish up the year. 0.25. So full 2%, same price, $440. What's that end at?
Same price.
Same price. Just without any inflation on prices due to demand.
Now we are at $4,357 a month. So a difference of...
Hold on.
Oh, sorry.
Yeah. Hold on. We doubled payments and we're dropping rates.
$2,357. So $502 difference.
$502 difference just by full 2% down.
Yeah. So now you can see the significance of that prediction. That is a big difference in a payment.
Well, hold on though. Let's just because the $400,000 market has been hot throughout all of rate hikes because there's so much demand from first-time home buyers who couldn't get into the market in 2022 and 2021 when it was at its most competition. So what's the real markets that have been hit by rates? 600,000, 700,000, 800,000, 900,000. Give me a price of 700,000 at today's variable, which is 6.3. Just because this is where you're going to see the significant returns or the significant gains, right? $700,000 purchase price, 6.3% interest rate, variable. Where are we at?
$4,548.
$4,548 right now at today's rate to buy that house
Per month, yeah.
per month. 2% drop, 4.3 variable rate. If we're going by that projection,
$3,751 for a difference of $797, so $800 almost. It's a big difference.
Go by now. We both agreed around 1%. So go 1% just to see how much it goes down by.
Yeah, sure. So let's say we go to 5.3.
5.3. Just see what it's at, variable wise.
Now you're at $4,140.
Down $400.
So you're down. Yep, basically.
Okay.
$407.
$407. Just for 1%.
Mm-hmm.
That's almost what you would have saved at the $400,000 going down by 2%.
Say that again, sorry.
That's almost what you would have saved at the $440,000 going up by 2%. Or it was 500.
Yeah, 502. Yeah, I see what you're saying.
Yeah, you're almost there, right?
Yeah, your mortgage is, that much bigger.
Yeah. Your mortgage is that much bigger because the purchase price is that much bigger, right?
Mm-hmm.
But the thing still shows that as soon as rates come down, people can afford more, which means that those price points that seem to be out of reach right now, because $4,500 for $4,500 mortgage for $700,000 today, that's a significant mortgage for that house.
Yeah, that's a big mortgage.
That's a big mortgage for that house, right? So if you're talking about that and it comes down by a full 2%, which is what they're predicting, that $700,000 price point becomes a lot more obtainable to a lot of people who would be willing to pay that.
You'll start seeing
prices go up,
and you'll start seeing sales in that
price point.
Yeah,
because it's slowed down a lot thanks to the rates. Because once again, $4,500 for $700,000 depends on the house and location for it to be worth it.
Yes,
it becomes a lot less. Buyers become a lot less picky when they can afford it. You know what I mean? Like if it drops down to a $3,730, now that's still a significant amount of money for a mortgage, $3,730, $800. Two good incomes, each bring in $90K a year, $80K a year, $100K a year. That's a good mortgage payment for you guys. That means everything becomes a lot more attainable to spend $700,000 on. So if you see a house for $600,000 in somewhere outside of HRM, or maybe just on the outskirts of HRM, and you're in multiple bids, which you will be in multiple bids if the rates come down that much, someone going to $700,000 is not entirely out of the realm of possibility because they can afford that payment thanks to these rates coming down.
Yeah. So, and sorry, I'm right now. What I'm doing is I'm going to 6, 7, 8. I'm going to show you what the purchasing power difference would be in those rate drops.
Ooh, okay.
I think it'd be a good little exercise.
How much can someone afford?
Yeah. So I got a client here. Let's just example client. Let's do this. Bear with me while I throw in some numbers here.
So we're looking at trying to qualify someone at these rates to see what they can and can't afford in a home purchase.
What I want to see is, right now I have an example client in here. They're going to buy a house at $500,000.
Okay.
At 5% down.
$25,000.
Mm-hmm. At our variable rate of 6.3.
Okay.
Okay. And what I'm going to do, and that's their max budget right now. They can't go any higher. Servicing ratio is 38.91. Can't go above 39. So they're maxing out there.
Okay.
Let's say this drops. Let's start off by 1%.
Okay, so 5.3. Down from 6.3.
Let's see how much more they can go.
Because we're working on variable because that's where they're claiming all the decreases are coming.
Yep.
Okay. Where are we at?
1 second. Just going to change the down payment there because they can afford more. We're going to be right around $45,000 more. So now they can go to $545,000. So in that same host, they could offer a max of $500,000. Now they can offer a max of $545,000. And the payment here is going to be the exact same. Right? So the payment is going to be, let me just show you here.
Yeah.
At the $545,000, $3,213 if they come down, okay?
Yeah.
So if we go back to where rates are right now and go back to this, I can't remember what I said there that payment was, but
you're at $3,200 and something.
Okay, perfect. $3,249 at 6.3. So
yeah.
if I'm a buyer and I
Yeah.
really like this house,
And rates are down a full percent.
so they're spending the same amount on a monthly basis, but the house is now
$45,000.
$45,000 more.
Yeah.
And that's where we see the prices start escalating, because to me as a buyer, if my clients are talking to me, a lot of times what I get is, well, what's my monthly payment? Like that's that's what is driving my decision, because I need to know if I can afford it on a monthly basis.
Yeah.
But again, to my point, you get in early, then that $45,000 is your equity if you buy earlier than later.
Go 2%. What's the budget at the full 2% drop? Because this is where it gets interesting, right?
You got your phone out there?
Yeah.
Just,
my phone right
so
here.
6.3 at $400,000 purchase, or sorry, $500,000 purchase. Okay.
Yep.
32.49.
Yep.
Let's say it goes down by 2%. Okay.
So
You're
32.49.
now going to be able to afford. Let's just.
My budget is $500,000 at 6.3 variable rate with a 38.91 debt ratio, 5% down.
30.
Monthly payment is $32.49 a month. If we go and decrease if we follow by the CIBC projections and we go down by a full 2% by the end of 2024 for variable rates, my monthly payments are.
Okay, you ready?
Yep.
Now you can go up to. Oh, what did I do there?
For his first time qualifying mortgages, guys. bear with him.
Yeah, there we go. Okay, so now you can go to a $600,000 down purchase.
Yeah.
Okay. Because we're down to 4.3 now.
Yeah.
And your payment is $3,187.
187. It is a $62 savings to go up $100,000.
Yeah.
And that's how prices go up.
So they go up.
That's how they go up. That's exactly how they go up.
So now, given that down payment's $10,000 more, so you got to make sure you have that down payment room, and
touch on
property
that.
tax goes up a little bit as well, which so there are other determining factors, but for the sake of just running numbers and demonstrating how when rates come down, why those purchase prices goes up. That's exactly why, because it's at the end of the day, if you're a consumer, you're wondering, okay, what do I have to pay every month in order to own this? Like that's the biggest thing, right? Is understanding that you can afford your monthly ongoing cost, your monthly cash flow, that your standard of living. You got to be able to afford that. Whether or not that reflects a $500,000 or $600,000 purchase is secondary. Yeah. In a lot of the instances.
Yeah, most people don't worry about everyone's worried about price, but it's usually about the house. Mm-hmm. People fall in love with the house, right? And then they worry about price, and the price is reflective of their monthly payments.
Yeah, so if you can buy that house when it's $500,000, let it appreciate, even though you got a high interest rate, and then in 12, 24, 36 months, lock into a lower rate, you get the best of both worlds. But there is a point of a higher interest rate, but again, the prices are down.
Prices are down. They're not down too much. I mean,
they're down to what they will be. Not down. They're not down from what they are in the past 12 months. They're down right now from what they're going to be.
Yes.
From what's coming.
You're going to get.
Yeah, that's an important distinction there. I'm not saying they're down from where they were. I'm saying in 12 months you'll say, oh, they were down back in.
Yeah, they were. Yeah, if you're looking at it, it's kind of like what 2020 was like, where it was like you started the year at X. And then you finished way above X at Z, and you trying to figure out how you got, $100,000, $80,000 above where you were at, and then you realized, the rates, because they dropped rates during COVID to stimulate the economy. So if you're thinking about buying right now, it's very important to pay attention to rates.
Yeah, and I do this exercise and so everything that we're talking about here is all speculation. This is like these numbers aren't going to come to fruition. It's probably going to land somewhere in between everything we've said. But the big takeaway here is just understanding your options and understanding the concept of how it works, of how when rates come down and things become more affordable, the prices are going to go up. So although there is obviously, some hesitation or concern that rates are high, it's really the best time to buy because that's when it's on sale.
Yes. Okay. Now here's a question.
The house. That's when the house is on sale.
The house is on sale. Yeah. I got you. We've talked about what they've predicted. Go back to that map.
Mm-hmm.
You've said 0.75 to 1. What does your year?
0.75 to 1.25, I guess.
What does your year look like? So look at the same dates. Where do you think it goes up, and where do you think they hold?
I think if you basically, I think Ben Tall's predictions here on when the rates will move is probably pretty accurate. I don't think there'll be much here in the new year. Come spring, I think there'll be a little bit of a drop. Come summer, I think there'll be, right before summer, a drop, and then into the fall there'll be a couple drops. And I think they'll all be quarter points. But again,
they know this is speculation. We're just speculating,
and that's just based on, I guess, just my personal opinion on what I think is going to happen. Rates, they'll increase them real fast and then they'll lower them real slow. So I think it's going to be a much more gradual.
Nothing like how they increase them.
No, I don't.
Increases hurt.
Yeah.
What are you doing?
I don't know. I think that it's I think they're going to come down slower than they went up.
Okay, I think it'd be April, June, July, September, November.
Yeah.
All quarter basis points, and then the rest are holds.
Yeah.
I'd be a prediction because they've already made it clear, like Tiff Macklin said in October, we don't necessarily have to reach 2% at the 2% inflation rate to start seeing rates decrease. And
he also mentioned that we could see decreases next year.
Yeah. So when he said
this year,
when he starts talking about that in October, that tells everyone, okay, we're ready, we're holding. So you're gonna start hopefully seeing them come down, and when you do, I think it's really gonna stimulate the market and buying.
Yeah, and I think the objective to get people to stop spending money and basically for people to start hurting, right? I think that's happening now. Like and I know people are,
okay.
Things are very expensive, and that was part of their plan, right? Is to get people to stop spending money, make things more expensive, and they've achieved that. And if they don't start lowering rates, then they'll start seeing some
foreclosures.
And some default on a lot of different credit types.
Well, let's flip this then. We talked about decreasing, right? The wave of increasing for the last 2 years. What have you seen from your clients? Your clients that went variable, that ate all of the increases, or they ate some and locked in. How have your clients been handling these rate increases on their monthly spending, and have you received any phone calls or talked to these people who are in financial constraints because of the rate increases in the last 2 years?
Yeah, and it's different. So, yeah, good question. And it's different for everyone.
Yep.
I've had some people lock in, and I've had a lot of people ride it out. A variable rate is very much a rate where you ride waves. It's variable. It's right in the word in the name, variable. It's going to go up. It's going to go down. Now we were faced with unprecedented times where it went up real quick and high.
You forget
a lot of clients stuck in them, and there's other reasons as well. Example for flexibility, needing to offload property if you're selling it. There's other reasons to have a variable rate mortgage as well.
Well, you can talk about me. Yeah. You sold me my mortgage. I'm on variable.
Yeah.
I'm up 70%.
Depending on your strategy, like a fix just doesn't fit. Same with me. Like I have mortgages that are variable, and that's due to strictly because there's an extra strategy there that needs to be executed. And if you're on the fixed side, the cost of that is just far too high. And then there's other people that went variable that, wish they wouldn't.
Yeah.
And they got squeezed. And some of them are still riding it out, and will kind of catch the back end here as well as it comes down. But it's like you mentioned, no one has crystal ball. A lot of people took variable rates on Tiff Macklin, as you mentioned. His advice back in 2021,
December 2021,
said he's not going to move rates till October 2023, which was a few months ago.
Yeah.
So a lot of people took out, in businesses, took out business loans on lines of credit. with heeding that advice that he gave.
Yeah.
So back to the thing, like all of these predictions that we're talking about today, they could all change and be the complete opposite. Do I think that's going to happen? No. But you never know. You never know what's going to happen.
Well, I think you can hedge your bet. I think you can hedge your bet that rates will come down a bit. I particularly, when you say Tiff Macklin setting up the market in 2021, he set it up great for what happened with rates. And I think probably it's more so our entire housing market, entire interest rate is based off of Ontario, BC. Whenever they apply a type of, I remember when they did the stress test, when they introduced that in 2016-17, that was for BC, Ontario, but they applied it across the country because the federal government treats housing as one facet for the entire country.
Also, an incredibly useful tool in the last couple of years.
100%.
Like that
saved the market. Saved everyone.
Saved the banks. Yeah.
Everything. That stress test saved everything from Armageddon. Because I guarantee you in that market in 2022, if they didn't have a stress test, they would have pumped it to the ceiling to get those houses. Yeah. It was that bad.
Yeah.
But when you bring that up, I wouldn't be surprised if BC and Ontario premiers or whoever's in political spectrum is putting a lot of pressure on TIF and the Bank of Canada to do something because their market and their price points on variable are significantly more. So we're talking about, you talk about a variable of $500,000 purchase, you drop it down to 2%, you can pay $600,000 purchase, and you save $62. Apply that same math to Ontario, Quebec, or Ontario and BC, where you can buy $1 million property and then you drop it down by 2%. What can you afford?
Double. Double. Like 5 to 6 is 100, so $1 million would be two. But then you're doing, you no longer can get an insured mortgage, so you're also it's more complicated, and there's more hoops, right, to do that purchase. But all I'm saying is just look at the math, and if that person's on variable, and they ate all the variable rate hikes because they weren't locking in, well, what's their payment at today? You know what? It just comes into effect of when you think of the market, and we can hop on Nova Scotia prices. We're not Ontario and BC prices. We're nowhere near them. And people here are hurting. You can only imagine what it looks like for those people on variable in Ontario and BC who paid $1 million, 1.1, 2, 3, 4, 7, 8, 2, right? Yeah, different market. And you get a lot in those areas. You get a lot of families buying together to qualify as well.
Yeah, it's just when you look on the back end of the impact of rates, that what we'll have across the market, not just us. I know what you're talking about. I know this is the Halifax Real Estate Podcast, but it's just a good thing to remember that when we're talking about these rates and their impacts, it's not just us that get hit by it, right? You and I have had clients. I can think of two off the top of my head that called us about selling after buying a few months after they bought because rates, they got hit by 1, 2, 3, 4 rates. And they said, if these things keep going up, we talked them off the ledge. We calmed them down, and sure enough, they held. And you talk to them today, and they're good.
Yeah.
They're very excited for 2024 if these rates come down. I am one of those people. But it's just understanding how these rates work and what the benefits are and if they can work in your favor, but also understanding that if you're looking at buying and the impact that these rates have and selling, right? If you're thinking about selling in spring and you can hold off to the fall, it might be better to hold off to the fall because you get less inventory, homes for sale. That's competition for you trying to sell your house. Rates might be further down the line, which means buyer can afford more, which means you might be able to cash out more money if you have nowhere to go. If that's just an investment property, or maybe you want to downsize into an apartment, good luck finding one, but you can try and do that.
Yeah.
There's a lot of ways that you can try and navigate this market and what we're predicting and what they're predicting at CIBC and other economists and other banks that can help you try and navigate the choppy waters. There's no perfect solution. There's no perfect formula. We don't know what's going to happen day to day. And if you've learned anything in the last 2 years about real estate individuals, we did not see 2022 coming. And we did not see 2023 coming with rates and their impact on the market. But with what you're seeing today, you can probably have a broader idea of what's going to happen and how you can best time your move. If you're trying to save the most money on your purchase, it's probably best to move now. Honestly, it's probably best to find something in February and get it under contract, or early March to get it under contract. Because if you wait for these rates to change, you're going to get more competition, and that will drive up price.
Yeah. That part, I guess you deal with a little more than me than buying and selling. But yeah, I would, if you can avoid anything, it would be to sell now and then buy in 12 months.
Please don't do that.
I guess is my only one thing. But yeah, it's and listen, it's not like like you mentioned, there's no right answer. Nothing's clear cut. It's life, to be honest. And the one thing I always tell people is, like, when they're talking to coworkers or friends and they're like, oh, I got this rate or I got this, there could be so many different nuances to that mortgage, that rate. Like, do what's best for you, do what's best for you and your family, the best way to protect yourself. Just kind of, if you're talking to your bank or your mortgage broker or whoever, just make sure that they are showing you the different your different options and understanding the payment differences, your different down payment amounts, different products. Like I said, there's 3 real ones you can go into: your variable and then your fixed side, 3 and 5 years. Is there a strategy behind that? Like, why are they recommending those products, and how that relates to where the current market is? So it's that's the big thing, is as long as you have all the information to make the right decision or make the best decision for you, then you're set. Don't worry about what happens to others. Just try and get the best thing to fit your situation, because everyone's different.
Buddy, thank you so much for coming back.
Thanks for having me.
Always a pleasure. All right, buddy. Have a good day.
Okay, bye now. See you guys.
Thank you so much for listening to the podcast. If you'd like to get in touch with Andrew Hutchison, you can reach him at 902-240-7212 or andrew@hutchisonmortgages.ca. And if you'd like to get in touch with me, you can reach me at 902-220-7357 or jason@infinityrealestategroup.ca. Thanks again. Bye.